All right, I think it's safe to say that 2022 was a bad year for the stock market. Pretty much everything was down. We saw bankruptcies, we saw collapses, we saw bubbles bursting left, right, and center, and it was a rough year. So in this video, I want to give you the basic summary of what happened, basically the cause and effect of how we got to where we are today, and my game plan for the year ahead. What's going on, you guys? My name is Zach Hartley, and welcome to my channel. Let's dive right in. Okay, so all of the charts that I'm about to show you are on a 1 year time frame. So it's basically today to 1 year ago, and this is what it looks like. This is the S&P 500, and as you can see, we basically went down right away as soon as the year started. In January, we were already down. February, we were down even more. And as you go through the year, it was basically a zigzag back and forth, dropping us down overall by about 20% on the year. Not a good year for the broad market index of the S&P 500. The Dow Jones did fare a little bit better. They basically finished around 10% down from where we started. However, you can see that basically when the S&P 500 went up, the Dow Jones went up, and when the S&P 500 went down, the Dow Jones went down. You can see that the patterns are actually fairly similar with regards to the timing of the bullish and bearish trends. However, the Dow Jones overall only down by about 10% this year, and it was actually the NASDAQ that took the biggest L for the year. Again, a similar pattern of bullish and bearish trends, but the NASDAQ finished down by almost 1/3 on the year. So pretty rough trading, pretty rough holding if you're a long-term investor exposed to these indices, which most people are. And honestly, it just wasn't a good year. For Bitcoin, it was even worse. Bitcoin was down by about 65% on the year. And honestly, the entire crypto space was down pretty massively. Now, the big question is, how did we get to this point? And it's actually a really interesting story of cause and effect that has basically put us into a whiplash. And I want to just summarize it for you really quickly here, because I think it's super important to understand these last 2 years and how they lead up to where we are today so that we can build a game plan for the future. So the first thing that happened here was COVID hit us in the beginning of 2020, in that kind of February, March, April time period. COVID was at its ultimate highest panic, and that caused absolutely everything to crash. The best stocks like Amazon, Apple, Google, they all crashed. All of these stocks came down because people sold out of everything because they were panicking. COVID set panic into the market, and when that happens, everything sells off. Now, once the initial panic was over, what happened is we realized that we were going to be okay eventually, and that work from home was going to take over. Basically, we were going to have to adapt, and one of the ways that we were adapting was, instead of going into the office and riding the elevator and the escalator up to the top floor and working with everybody all day long, we were going to end up working from home. And because of that, certain companies did extremely well. Think of Zoom, the video conferencing service. Their stock absolutely skyrocketed because all of a sudden there was an increase in demand for their services caused by the COVID work from home trend that was taking over. Now, while that was happening, it was really interesting because some companies didn't do quite as well. And because of that, government started printing money to help out those companies and to help out the consumers that weren't in these industries and weren't going to be able to recover very quickly. They also gave out very low interest rates to stimulate the economy, and because of that, stocks rose. You can remember that people were locking in mortgage rates as low as 2%. Now we are sitting at 5 and 6%. Because of that, government printing money, and because of those low interest rates, we saw the entire economy do extremely well for basically the second half of 2020 and almost all of 2021. And stocks skyrocketed. Almost everything went up over that time period. However, the negative effects were soon coming into view. The extra money in the economy caused by that printing money basically caused inflation in the regular consumers' lives. This then forced the federal banks to start raising interest rates in order to slow down the economy and combat inflation. So all of the money that we printed, that we gave to companies and that we gave to consumers, basically meant there was more money chasing after the same amount of goods, or even sometimes a restricted amount of goods, because of the COVID lockdowns. That drove the prices up, and that caused inflation for the average consumer, basically meaning that your dollar doesn't buy as many goods because there's more competing dollars for those same amount of goods. That forced the federal banks to raise the interest rates to try and combat inflation, slow the economy down, and bring us back to normal levels. Now, while that was happening, while those interest rates were rising, we also had high inflation. So those things were happening at the same time. We had high inflation, and to combat that, there were rising interest rates, but the inflation hadn't really started to decrease yet. So we were battling both of those monsters at the same time. We also had a slowdown in China and a war in Ukraine, and all of that happening at the same time compounded onto each other. And that is why we saw one of the largest sell-offs that we've seen in the market in recent decades. Now, I know that was a lot to take in, and that was kind of just a big, long story, but what we need to think about now is this is where we're at today and what is next. So here is my prediction, my plan for 2023, and what I think is probably going to happen. Obviously, some of these bullet points are going to be wrong, but I do think one or two of these are going to be pretty right. Number one, China is going to reopen and continue to expand. I know that they're going through a bit of a COVID surge right now, but I think the government has finally realized that they cannot go into these lockdowns forever. Because of that, they're going to slowly start to recover, and I think China represents one of the best value opportunities when you look at the global economy. I think a lot of their great companies have sold off very, very heavily, and I think they represent good value. Secondly, I think the higher interest rates are going to continue to put stress on people with debt or high mortgages. If you have a massive mortgage that you need to refinance in the next year or so, you need to make sure that you are prepared for that. You need to make sure that you understand that, and you need to make sure that you're ready for it, because these higher interest rates, I don't think they're going away very quickly. However, I do think the companies that are profitable are going to be the first to recover. So the companies that are already profitable, that have pricing power, that have a strategic advantage, and that are already generating good revenue and good profits, those are going to be the companies that are the first to recover. It's the tech companies that don't have any profits and that don't have a clear path to profitability. Those are the companies that are going to be the furthest out or the last to recover. I also think globally, energy security is going to become more and more important. I think that having an ability to produce and secure your own energy, right now being fossil fuels, hopefully in the future being renewables, I think that is going to be extremely, extremely important because of what we have learned this year and what Russia has done to the rest of Europe. I think we're going to see a lot more importance placed on this. I also think that strong dividend companies are going to become more attractive. People are realizing and understanding that their portfolio can take a 20 or 30% dip very, very quickly, and that cash flow that the dividends provide from strong and steady companies is actually very, very valuable, especially in times like this. So that is what I think is going to happen in 2023. That is where I am positioning myself and preparing myself. As of right now, my portfolio looks like a lot of cash, either held in my investment accounts or held in high interest savings account. I'm planning to buy some property in the next year or so. So that is something that I am preparing for. I have a couple of long-term positions in Apple, Amazon, and Google. I'm also mining and holding Bitcoin. I think we are probably going to be at the low for Bitcoin in the next little while here. We're basically at the end of a 4-year cycle since the last low. And so I do think this could be a time to start accumulating some Bitcoin for the future and for the long term. And I also find myself doing a lot more day trading these days. So I want to share that more on the channel. If you're interested in learning about that, definitely consider checking out the links down below. You can find all of my content on Skillshare. That is where I post all of my courses, and that includes courses on personal finance, day trading, credit scores, dividend investing, and everything is linked down below. It's completely free. Skillshare is like the Netflix of courses. You can scroll through, take any course you want, and it's completely free for the first month when you sign up with the link down below. You can take all of my content there, and I promise you it'll be well worth the time, well worth the effort, and it won't cost you a single penny if you cancel that subscription in under a month. Thank you guys so much for watching this video. I sincerely appreciate it, and we'll see you in the next one. Good luck trading, good luck investing, and we'll talk to you soon.